All right. How's everybody doing? So I posted a Instagram short about don't buy property in California until you understand the California supplemental property tax bill. And that video blew up. I got 40,000 views, which is very unusual for me. Over 1,000 comments, a few thousand shares, and a lot of people pissed off about the property tax in general, which I can understand. I mean, nobody wants to pay taxes that doesn't have to pay taxes. But I wanted to do this video today because there were so many questions that I thought I would do a kind of frequently asked question thing. Um, a lot of people wanted to know what created the assessment, what triggers it, what happens if parent passes it down to a child, and I'm gonna wing it today, but I think I used to do this for a living. Actually, for like 20 years, I fought the local California county assessor and actually all 50 states on property taxes. So I do actually have some understanding of property taxes, and hopefully this will help. So let's start with the beginning of what a California supplemental property tax is. It is an addition to your regular property tax bill. And in its purest form, if you were to buy a house for $1 million, and I'm just throwing that number out there, I know a lot of part of the country, $1 million is a lot of money for a house. We're specifically talking about California and not about the other states. So if you aren't in California, maybe this video is not for you, but maybe you could share this with your friends or family who do live in California. All right. So if you buy $1 million house and the assessment of that house was only $200,000 when the previous owner owned it, you are going to get a supplemental property tax bill of the difference. So $1 million is what you paid for it. $200,000 was what it was worth before. So you're going to get an 800,000 assessed value dollar supplemental tax bill times the tax rate. So that's going to be probably a pretty significant tax bill, well over $10,000. And it's not going to show up right away. It could show up 18 months after you close escrow. So there are calculators on all of the California assessor websites that you can use. So if I were you and you have any questions about this, you go to the California, whatever county you're in, go to the assessor's website, type in supplemental tax calculator, and you will find one. If you do transactions in California, you also have a calculator that's a piece of paper that is usually part of your natural hazard disclosures, funny enough. So you can do that calculation there. And thirdly, when you're closing escrow, the escrow company most likely will walk you through the supplemental taxes that will be coming due. So you have 3 opportunities to understand it before it shows up on your in your mailbox. So when are they issued? So the supplemental tax bill is triggered by a change of ownership. Now that is a very broad term. It does not have to be you buying a house. It could be that you change the ownership title of a house. So, for instance, be very careful if you're taking ownership from a parent. There are forms that you can use. It's a change of ownership form that you can fill out that can exempt you from the supplemental tax, but this is not always the case. And let me repeat, be very, very careful about changing title on your property in California because it will likely trigger a supplemental tax bill. How you avoid that is you do your research before you change title, and there is the form you can download from all of the 52 or 58 counties in California, and it has exemption boxes. So make sure that if you're doing it and it's like a family thing that you apply for that exemption. All right. So a supplemental tax can also be triggered by renovations. So if you complete construction on your property, like put a pool in or do a major renovation, add a bedroom, anything like that, they're going to revalue your property based on those renovations, and they're going to take your old tax amount and or your old assessed value and your new assessed value. They're going to subtract it from each other, and that difference is going to be your supplemental tax bill. So that would be a much smaller supplemental tax bill potentially. Let's say you bought the house for $1 million a few years ago. You just put in $100,000 into expanding your house. And they say, oh, your house now is worth $1.3 million. Well, that difference is $300,000. So, that still is going to be about a $4,000 or $5,000 tax bill. So, how to do your assessment calculation? That is, you go by the current market value upon the event. So let's say you have construction done on your house, or you have a close of escrow, that is your event date. The date that the county allows you to have the date that you close escrow is definitely the event date. But let's say you're doing some major construction and you get a clearance from the county. Well, that could be your event date, that clearance. So understand what the event date is of your supplemental tax calculation. Tax in California is a 1% tax rate. That is Proposition 13. That was put in like 1975-ish. I know a lot of people got political about, it's got to be the Democrats who did this. Funny enough, it was actually the Republicans who initiated Prop 13, and the anti-tax group, I think they were called the Jarvis Anti-Tax Group, thought this would be a more equitable way of doing taxes. So without getting political on this channel, and please keep your comments to yourself when it comes to politics, it's not something that you can avoid. It's not something that the Blues did recently against the Reds. So let's just stay out of it. And there's no way you're going to avoid this tax unless you have an exemption of some sort. So we can complain about it all we want, but we're still going to be paying it. The tax is issued, like I said, on a change of ownership or on new construction. The timing of the billing is kind of interesting. So the timing of the billing can be either January through May. You might get two supplemental tax bills. Or if your event closes in June and December, you'll probably just get one. The reason is because California has a fiscal year end of June 30th and a fiscal start of July 1st. And it has to do with the fact that from January to May, you're in the second half of the fiscal year versus June to December. I think they meant July to December personally, but it may be June to December. Anyway, payment and penalties. If you don't pay your supplemental property tax bill on time, they can charge you a 10% penalty on top of the supplemental tax. Talk about an insult on top of an insult. Refunds. I had several people ask me about refunds. If a new assessment is lower than the prior assessment, you actually might receive a refund. So let's say that the assessed value on a house was $1 million and you bought it for $800,000. Well, that's a $200,000 difference. You might actually get a refund on that $200,000 assessed value, which could be several $1,000s. So they do, on occasion, offer refunds, but I've honestly, in the 25 years that I was doing property tax work for consumers and companies against the assessor's office, I didn't see a lot of refunds of supplemental property taxes. I did see refunds on appealing your assessed value if you thought the market value was too high. Exemptions. Homeowners can only apply for exemptions within 30 days of the notice. So make sure you get that notice, or else you may miss out on the possibility of filing for an exemption. So if, for instance, you get a notice of a supplemental tax bill, which when you close escrow in California, I'm not sure they actually mail out a supplemental tax notice. They might. most of my clients have been surprised, even after I've told them that they're going to get this, because it's so long between the close of escrow and the time they get the supplemental tax bill. But if you do get that notice in the mail, it has a 30-day time limit for you to appeal it. So make sure you do that. All right. You definitely want to appeal your assessment if you feel that it's not correct. The assessor's office makes mistakes. I saw it a lot in my 25 years of working in property tax. There were plenty of clerical errors and just mathematical errors. So pay attention to your bill. Also know this, even though the property tax rate is 1%, this does you also will be taxed based on the bonds and special assessments that are part of your tax bill. So it's not just going to be a 1% of 200,000, which would be $2,000. You're going to pay $2,000, which is the property tax plus another however many bonds or special assessments or Belarus you have, or school taxes or bonds or library taxes or whatever, road. It could be sewer taxes. It could be any number of things. Those will all also be on that supplemental tax bill. So just know that. All right, a couple of important things to note. I got a lot of people saying this is double taxation. It's unlawful. I hear you, but it's not double taxation under the law. It could be double taxation in your mind, and I totally get that, but it is not considered double taxation under the California Constitution. I am not an advocate for supplemental taxes. I think that it's just an insult. So don't beat me up on this, but it is not a double taxation. Quick sidebar, which I always thought was double taxation, was when I was working in some other states, they would charge sales tax on their property tax. Now, that to me seems like double taxation. And even that stood up in court as not double taxation. So be happy they're not charging you sales tax on your property tax. All right, check due dates. So property taxes in California are due December 10th and April 10th. Supplemental taxes have their own specific due dates. They are not December 10th and April 10th. So the first half payment is due December 10th for your regular property tax bill in California. Your second half tax bill is due April 10th of the next year. Remember I told you the fiscal year was like July 1st to June 30th? So that's why. Supplemental taxes have their own due date, and it could be any time depending on when it's issued. So don't rely on December 10th and April 10th. Payment responsibility. Homeowners are responsible for paying these bills, even if they expected their lender to be paying these through the impound account. Another big question I got. Often your lenders don't know these supplemental tax bills came in, or they put them in a drawer somewhere and don't pay them on time. You are responsible for paying these bills on time. Don't use your lender as an escape for trying to get out of the 10% penalty if it wasn't paid on time. All right. I know I'm just nothing but bad news today. I'm sorry. All right. Some more of the frequently asked questions. I already went over what a supplemental property tax bill is, or how it's issued. It's on change of ownership or new construction. A little background. Why did you get one? Because under Prop 13, when a property changes ownership, the county can reassess the property to its current fair market value, which is 99.9% of the time what you paid for the house. It's rare that you can get it to be lower than what you paid for the house. And I've never seen them assess it for more than you paid for the house. So if you think you overpaid for a property, if you can prove to the assessor that you overpaid for it and that the true market value is less than what you paid, then you'll want to file an appeal, put your case together, and maybe you can get your supplemental taxes lowered. All right? Don't hold your breath. I told you this channel is called Keeping It Real. Well, I'm keeping it real. Don't hold your breath. We used to win a lot of cases on overvaluation of property, but it usually had to do with new construction not change of ownership based on a purchase. So if you're building onto your house and you get a supplemental tax bill, keep all your receipts, because let's say that you built a new wing on your house, and then you'd somehow decided halfway through, after you'd spent a bunch of money, that you wanted to change it. Well, those changes may not actually add value. And the assessor is going to look at the permit. And if the permit was pulled for $300,000 and you spent $300,000, but really you only added $200,000 worth of value, you might actually have a case to appeal your property taxes. It gets complicated, but I think you get the gist of what I'm going for here. It's all about, so there's three ways that property can be assessed. It can be assessed at market value, at cost, and I'm drawing a blank on the third one. I'm sure somebody will remind me of what the third one is. Um, but usually it's the cost to build or the price you paid, the market price. Sales comparables is the other one, which is kind of market value. Um, and I still may be wrong on that one, but anyway, um, again, reminder, this may not be part of your impound account with your mortgage company, so be aware of that. It's definitely not part of your principal, interest, tax, and insurance calculation that you did when you were working with your lender. So be aware of that. Is it part of your regular taxes? It is not part of your regular property taxes. Those taxes in California are due in two installments on December 10th and April 10th, which I mentioned. The assessment usually comes out in September to November. The tax bill is issued in early December. You pay the first one on December 10th. You pay the second half in April, and then you wait until the next year, and the cycle repeats. It goes up in value. It can't go up more than 2% a year, but it does go up. Under Prop 13, 2% is kind of the cap. So you're lucky there. So there are states like back east in New England where the property taxes can range wildly from one year to the next, the assessed value. So as much as we hate taxes in California, they've capped that increase to 2% a year. How does Property 13 affect this? Prop 13 generally limits the annual increases to 2%, which I said, unless there is a change of ownership. Then they can trigger it based on whatever the cost of the change of ownership or new construction was. So the 2% that I just mentioned goes out the window. All right. 2% is not the limit when you buy, just like I just said. That becomes the market value. Don't rely on that 2%. The supplemental I mentioned early in this video is calculated based on the difference of the assessed value when you bought the house to what you paid for it now. So again, if the house was assessed at $200,000 because grandma lived in it or an old couple lived in it, you buy it off the old couple and you paid $1 million for it, that $800,000 difference is going to be your supplemental tax. And then next, your regular tax bill is going to be based on the $1 million that you paid. So you're going to get two bills, basically. You're going to get a supplemental bill and then your regular tax bill. So have fun with that. Can you receive more than one supplemental bill? Yes. That was another big question I got a lot. Yes, you can, depending on what time of the year you bought the property, and if you're in the current fiscal year or the next fiscal year. It can affect both fiscal years. Again, don't kill the messenger. I know it sucks. What if my purchase price was lower? We talked about this. There is the potential for a possible refund. Does new construction trigger? Yes, we talked about that. When will the supplemental tax bill arrive? I mentioned this a couple of times, but it could be up to 18 months. I've actually heard people say it didn't show up for 2 years, and that's just the bureaucracy of whatever particular county you're in. The bigger counties take longer to process supplemental tax bills, especially if there's hundreds of thousands of transactions going on in the county. So a big county like Los Angeles can take forever to get a supplemental tax bill out, whereas a small teeny county like Yolo County or Alpine County in California, which only has probably about 20,000 people, you could get the supplemental tax bill pretty quickly. Who pays the supplemental tax bill? This is a good one. The buyer usually pays a supplemental bill that's a result of the reassessment of the purchase. Normal property tax prorations between buyer and seller are handled through escrow, but the supplemental bill is the responsibility of the buyer. So when you're at escrow and you're closing on the sale of a house, they will do a calculation on the current property taxes, but not the future supplemental. So that proration that's being done at the closing table is only on the current property taxes due through the end of that fiscal year. The supplemental will come later and it's the buyer's responsibility. Can you appeal? Yes, you can appeal. If you think the value is too high, you may file an assessment appeal with the county, but pay attention to the deadlines. They are not the normal deadlines. They are deadlines based on when you receive the supplemental property tax bill or a notice of the supplemental property tax bill. So read the code, go to the county assessor website in the county you're in, and it will explain exactly how you do the appeal process. So, what should buyers prepare for? Buyers should budget for their supplemental property tax bill after closing. Talk to your real estate agent, talk to your escrow officer at the close of escrow. Make sure you know what that rough estimate of your supplemental tax bill will be before you get it so that you've set that money aside and you're not shocked. Again, your lender 99% of the time will not pay this bill on your behalf through an impound account. So it's coming to you. All right. So make sure that you calculate it correctly. Lastly, what's the big takeaway? Supplemental property tax bill is not a penalty and it's not a duplicate tax bill. It is California catching up on property taxes due based on the reassessment of either a transaction, close of escrow, or new construction. It's that simple. I hope this helps everybody. I hope this answers most of everybody's questions. Oh, there were some questions about interfamily transfers, trusts, things like that. I would highly suggest that you talk to your attorney about those things because those can get really sticky. As a real estate agent and broker, I'm not really allowed to speak to anything that might affect your tax um, income taxes or any tax advice other than I'm just giving you information. This video is literally informational purpose only. It is not tax advice. Please speak with a tax professional. I repeat, talk to a tax professional. I'm just a California real estate broker who happens to know a little bit about property taxes, but I am not an expert anymore. And I'm just trying to give you the best information possible. A lot of people asked about trusts and transfers. Living revocable trust, I think, can be exempt, but again, check with your trust attorney or check with your local assessor's office. Call them; they will give you all the answers for free. They're a great resource. Your local county assessor's office. All right. Please like, comment, subscribe. We're growing the channel. We're almost at 5,000 people. So thank you all so much who've been paying attention. And I hope to talk to you soon. In the meantime, have a great day, everybody. See you later.